Hi guys, welcome to Bankers Cafe. In today's session, we will talk about external commercial borrowing. This gonna be part 3 of ECB, where we will discuss about below topics. Right? Who are eligible lenders under a ECB transaction? We will discuss in detail. After that, we will talk about liability equity ratio. We will also discuss this in detail. So let's begin. Eligible lender. The all sorry the all type of lenders were classified into three groups: track 1, track 2 and track 3 as per the Reserve Bank of India guidelines. Right? Now we will discuss these all three tracks in details. Before understanding about these three tracks, we should know who is eligible lender is. Basically, it can be an individual, it can be a bank, it can be a company, it can be an organization, right? So, eligible lender is who? It is the one who is lending the money to the borrower. That is called eligible lender, right? Now, there were few things that we should be aware about that. The eligible lender should be a recognized entity, right? After that, it should be a non-resident entity. It should be a non-resident entity in relation to that borrower, right? Eligible lender should be a resident of FATF compliance country. FATF means the Financial Action Task Force. This organization is listing few countries, right? So it should be a part of those countries. It has listed some blacklist countries, green list countries. So the eligible lender should be a resident of a FATF compliance country, right? So you need to remember that. Now let's move forward. Now we will talk about now who are the eligible lenders are. Who are eligible under track 1, who are eligible under track 2 and under track 3, right? So track 1 is basically a mid-term loan. Track 1 is a mid-term loan which is in foreign currency. The MAMP means the minimum average maturity period should be 3 to 5 years of such loans. So we can say that track 1 is what? It is a foreign currency loan having a tenor of 3 to 5 years. And these loans are medium term loan, right? So under track 1, these were the organizations are listed: International Capital Market, overseas branch of any Indian bank or subsidiary of any Indian banks, supplier of equipment, international bank, export credit agency, foreign equity holders. So these were the organization or the entities who were listed under the track 1. Means such organizations can provide medium terms loan which is in foreign currency or having a tenor of 3 to 5 years, right? So these were comes under track 1. Now under track 2, first before understanding which organization are coming under track 2, we should know about the track 2. Track 2 is a long term loan, whereas the track 1 is what? It is a medium term loan. But here also it is also a foreign currency loan, but it is a long term loan. You need to remember that. MAMP will be above 5 years and up to 10 years, right? Now we will talk about which organization are included under track 2. Track 2 is basically including all the organization of track 1 except one organization, which is overseas branch or subsidiary of any Indian banks, right? Where in track 1 we have seen that there were 6 organizations were there. Track 2 is also including all these 6 but except this. Means this and these 5 were included, but the overseas branch is not included under track 2. right? So all the entities which are listed under a track 1 except this can grant long term loan, right? Now we will talk about track 3. Track 3 is basically a INR based ECB loan, right? Whereas track 1 and track 2 is a foreign currency loan. It included the rupee denominated bond, masala bonds, right? So under track 3, all the entities which are listed in the track 2, along with that NPO, NGO and MFIS. NPO stands for non-profit organization, NGO stands for non-government organizations, right? We all were aware of this, so I am skipping these points, right? MFIS means microfinance institution, which is providing microfinance facilities, right? So who can grant ECB in INR? The track 2 one and all these three entities, right? Now let's move forward. Now we will talk about the international capital market, which is one of the part of track 1, that is international capital market. Now we will discuss all these lenders in details. First we have taken international capital market, right? Now what is this international capital market is? It is basically a market or a platform, right? Which includes any individual, right? Any entity, any government. It can be a state government, it can be a national government, right? So it basically a platform or a market which is providing transfer facilities. Transfer facilities means where the lender is having excessive fund and the borrower on the another side, the borrower is in need of fund. So in that case, the lender is providing the excessive fund as per the requirement of the buyer, right? So the lender transfer their excessive fund to the borrower who is in a need, right? Such transfer basically happens beyond that territory of a country. For example, I am a Indian, right? And the lender is a of China, right? So I need a fund, and the resident of a China is having excessive fund. So I have requested them. Then I requested the resident of a China to please lend some money, right? So it can transfer that money to me. Then such transfer will be across the territory of that resident, right? Means such transfer is happening from China to India, so it is beyond the territory of the borrower as well as of the lender, right? So under this, someone is borrowing money and someone is investing money. It can be in the form of debt financing, it can be in the form of equity financing. Debt, as we all know about that, debt is when we borrow money from someone, then we need to return it back to that lender as well as, so it is means that we owe some money from them, so we need to return that funds to that actual lenders, right? So debt is what? It is our liability to return that fund back along with that interest to the actual lender. So in debt financing, what we are getting money, right? Whereas in equity financing is basically when a lender is investing a money in a borrowing company, that is called equity, right? So when the lender is investing money, then it is acquiring ownership of that company up to that amount which is he or she is investing, right? So someone can be accessing that capital market via two routes. It can be via debt financing, it can be a equity financing, right? Now let's move forward. as now we will discuss what is equity. So here is the lender, here is the borrower, right? So lender is investing the money. Lender is investing the money in occupying the shares of that borrowing companies. That is called equity, right? So whatever the portion of money is invested by the lender, then the lender would become a part owner up to that amount, the amount which is invested by that lender. That is called equity, right? Now we will talk about the structure of international capital market, actually how it is happened, right? So basically there are two type of markets under international capital market. These market are primary market and the secondary market. Primary market can also be called as new issue market, right? Whereas the secondary market can also be called as after issue market, right? Under primary market, new securities were issued. Securities, it can be a bond, it can be a stock, right? So new security were issued here. Suppose I am a borrower, I need a fund, then I will issue those securities to the purchaser. Here issuing means what? Issuing means what? Selling. Here issuing means selling. So whenever I am issuing the security means I am selling the security. So here borrower is doing what? Here the borrower is issuing the securities. To whom? To the lender, to the purchaser, whatever we can call it as. Right? So here purchase means, here purchaser is who? Here purchaser is the lender. Right? Whereas on the secondary market, the securities which are issued in primary market, then such securities were traded on a secondary market. Under primary market only security were issued, but here in secondary market such security were used on a stock exchange market for a trade purpose, right? So in simple, under primary market, if borrower needs a fund, then it will issue security to the lender. Then the lender will advance the funds to the borrower, right? Under secondary market, the stock exchange is facilitating. The stock exchange is doing what? It is facilitating the trade transaction between a seller and a buyer. Now you need to remember one thing. The thing is that, as we know, the thing is that once the security were issued, then there is no role of issuing company under a secondary market, right? When the issuing company has issued the security, then its role is over. Now three parties will be there: the seller, the buyer, and the stock exchange market, right? Now let's move forward. Now we will talk about the foreign equity holder. This is one of the type of eligible lenders who can lend money to the borrower, right? Before understanding about foreign equity holder, let's segregate these words. Foreign means any non-resident, right? Equity means the money invested. Holder means getting a ownership, right? So if I combine all these three words, then what would I get? Means any non-resident entity or individual, when it's investing a money, then it's become a owner up to that amount. That is called foreign equity holder, right? Now under this, one is the lender, another one is the borrower. The lender should be a non-resident entity. Means it should be a non-resident entity which is a foreign entity, right? Borrower is a Indian entity which should be a resident of India, right? So here the lender is a foreign equity holder, When it become a foreign equity holder? When this lender is acquiring the stake or the share of this borrowing company, or holding that stake in the borrowing company, then this lender will become a foreign equity holder, right? Foreign equity holder basically divided into three groups. One is the direct equity holder, the another one is the indirect equity holder, and the third one is the group company with the common overseas parent company. Now, what is these three companies were? Right? Let's discuss them in detail. First, we will take up with direct equity holder. As the name shows, direct means here the holder is acquiring the shares of a borrowing company directly with no involvement of any intermediary, right? So here the lender is acquiring or holding the stake in the borrower company directly, right? Now, if the transaction of that ECB means the value of external commercial borrowing transaction is within $5 million, you need to remember the amount. If the value of ECB transaction is within $5 million, then the foreign equity holder should have to maintain minimum 25% holding in the borrowing company, right? If I am a borrower, I am applying for a ECB transaction, right? So if the value of transaction is within $5 million, then the overseas lender means the foreign equity holder should have to maintain minimum 25% holding in my company, means in the borrowing company. So here the lender has to maintain minimum 25% holding in the borrower company if the value of ECB transaction is within $5 million. If the value of ECB transaction is more than $5 million, then it also has to maintain 25% holding. Along with that, the DE ratio should not exceed 7:1. Earlier it was 4:1. Now it is 7:1. 7:1 means here that the total of all ECB along with this proposed ECB, right, should not exceed 7 times of that holding by a foreign equity holder. Whatever the value of shares or whatever the value of ownership it is having with the foreign equity holder, then the 7 times of that should not exceed, right? The value of transaction of that ECB along with this current ECB should not exceed the 7 times the value of the holding by a foreign equity holder. So you need to remember this, right? Now we will talk about indirect equity holder. This is also a equity holding by a foreign equity holder. But here the lender is not directly holding such equity in the borrowing company. It is holding through a intermediary. That intermediary is a AMC, means asset management company. Now what is this AMC is? AMC is basically a organization, right? Which is pooling the investment or pooling the money or pooling the funds from several investors. After that, it's invested those funds in different securities in different companies, right? So here the lender is also a equity holder but through AMCs, means through a mediator. In this case, under indirect equity holder, the foreign lender should have to maintain minimum 51% holding stake in the borrowing company. Then it can become the eligible lender if it is an indirect equity holder. If it is a direct equity holder, then it has to maintain only 25% of the holding. Now such holding can be in the form of ELMF, ELSS, ULIP. What is this? ELMF stands for equity linked mutual funds, right? ELS, equity linked savings schemes, ULIP, unit linked insurance policy. So these were SIPs, right? So these were the examples by which a lender can acquire securities, shares of a borrowing company, right? Now let's move forward. Now the third one is the, as we have gone through this, the third one is the group company with common overseas parent company. Now what is this? Here is the borrower and here is the lender. Now when now the lender along with the borrower both were a part of a subsidiary company, which is a subsidiary of a parent company. Means here the borrower and the lender both are a subsidiary of a parent company. Then in that case also the foreign equity holder can make the payment, make the loan procedure completed, right? So if the lender and if the borrower both are belong to the same subsidiary of a same parent company, then in that case also that lender can lend money to the borrower, right? Now export credit agency, it is the another type of eligible lenders, right? So as the name shows, export credit agency, the agency which is formed to provide credit support to the exporter, right? So export credit agency basically provides these three facilities for an exporter. These facilities are financial support services, risk insurance services, right? And other services, means evaluation of importers' creditworthiness, evaluating of the risk associated with these transactions, providing any guidance with these export transactions, right? But these agency will also provide facility for the importer as well, as not only exporter but also for importer also. So these credit agency can also become a eligible lender for the importer by providing that ECB loan. So the export credit agency can also provide ECB loan to the borrower. So you need to remember that. Here it is not only for an exporter, it can also provide import, it can provide ECB loan to an importer also. Out of the total country in the world, something around 80 to 85 something countries were having that ECA account, means EC agencies, which is providing such facilities, right? After that we will talk about the another type of eligible lender, that is supplier of equipment. Supplier of equipment, it can be any supplier that supplies the equipment. The supplier can be a individual, it can be a company which is supplying the equipment, right? Equipment can be in the form of goods or it can be in the form of services. So in simple word, I can say that it can be a person, it can be a company which is supplying goods or rendering some services to its customer, that is called supplier of equipment, right? So I have made this diagram just for understanding this concept very clearly. So supplier, it can be a person, it can be an individual, right? So whereas equipment can be goods or services, right? So whenever a person providing goods to the buyer or the customer, or providing services or rendering services to the customer, then what is called, it is called as supplier of equipment, right? So it can be a person, it can be a company which is providing such goods or services, right? Now let's discuss about another form of aspect of this external commercial borrowing, that is liability equity ratio. Now what is this liability equity ratio is? We can also call liability equity ratio as debt equity ratio. Both means the same. We can call it as debt equity ratio, we can call it as liability equity ratio. Liability means the debt, so here both means same. Now what is the formula for evaluating liability equity ratio or debt equity ratio? So the formula is debt divided by equity, or we can say that liability divided by equity, right? So debt can be a short term debt, it can be a long term debt, or any fixed amount which is need to be paid, means any liability, other fixed liability also, right? So equity means the money invested, means the money invested by a investor, means the shareholder equity, right? Now what is this and what are the uses of such in external commercial borrowing transaction is we will discuss the same in this. Now whereas the liability equity ratio under a external commercial borrowing will apply, right? So if a external commercial borrowing transaction is with here, now wherever we in which transaction would it apply and in which transaction it would not apply, right? Whenever the transaction value of a ECB is less than $5 million, please remember, please listen carefully. If the value of ECB transaction is less than $5 million, then the liability equity ratio would not apply neither in automatic route nor in approval route, right? I hope that you all were having clear about this, that if the value of ECB is less than $5 million, then it will not apply to any transaction, whether it is fall under automatic route, whether it's fall under a approval route, it will not apply, right? But whenever the value of a ECB transaction is more than $5 million, then it will apply, right? Then in under automatic route, then the DER means the debt equity ratio or the liability equity ratio should be 7:1. It should not exceed about that ratio, right? If it is a automatic route transaction, then it would apply and the ratio should be 7:1. It should not exceed the above ratio at any cost, right? Under approval route, it solely depend on the RBI whether they allow that transaction or not. But under approval under automatic route, the liability equity ratio should be 7:1 if the value of transaction is exceeding $5 million. The last one is the overseas branch oblique subsidiary of Indian banks. These were the last eligible lenders who can lend ECB loans to the borrowers, right? So any Indian bank having its branch in abroad countries can also lend ECB loans. If any Indian bank having its subsidiary, then these subsidiary can also lend ECB loans. Now thing to be noted that overseas branch or subsidiaries of any Indian banks can lend ECB loans in foreign currency only. Means such overseas branch or overseas subsidiary can lend foreign currency ECB loans only, no Indian currency ECB loan they can't grant, right? Also thing need to be noted that no FCCB means foreign currency convertible bonds or the foreign currency exchangeable bonds, they can't issue these two also. Means overall they can issue only foreign currency ECB loans except FCCB and FCEB. Right? In the end, we will talk about some key points which we need to remember under a external commercial borrowing transactions. Debt equity ratio, or we can say that the liability equity ratio can only applies to the foreign currency ECB loans. If the value or if the currency of ECB is in INR, then debt equity ratio would not applied. That equity ratio only applied when the ECB is in foreign currency. If it is in INR, then it will not apply. Debt equity ratio will apply only to direct foreign equity holder. If the foreign equity holder is an indirect equity holder, then it will not apply. But if it is a direct foreign equity holder, then debt equity ratio would apply. After that, it will only apply, means the debt equity ratio will applies to those ECB transaction whose value is above $5 million. Then it will apply. Also, the last point under debt equity ratio, which we need to remember, that it will only applies to the transaction which falls under automatic routes. It will not apply to the transaction which falls in an approval route, right? After that, the last key point which I have missed in earlier one, so I am mentioning here. MAMP means the minimum average maturity period should be, can be 1 year also if it is a manufacturing company and the value of ECB is within $50 million. Means a manufacturing company can also avail ECB with a minimum average maturity period of 1 year if that value of ECB is below $50 million. If it is above, then it has to be 3 to 5 years, right? So this is all about my video. Thanks for watching. Keep learning.